Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Shikhar Garg, your host. Now, before we begin, I'd like to wish you all some great time ahead with all the festive spirits going on. A very happy Ganesh Chaturthi and also Mechami Dukram for any of the mistakes that done over the past few days, weeks, or a year. Coming back, we had quite an interesting day for currencies last Tuesday and still seeing some follow through on it. USD INR came down from 79.90 to 79.45 with certain flows and stop losses getting triggered. On the global front, the energy prices for Europe look to be correcting quite significantly. Reminds me of the interesting question raised by Mr. Holger whether these price movements are these pure speculation or are these meaningful prices that actually reflect real scarcity. So JK, what do you think? Are these real prices? What sort of correction are we seeing in energy prices? What should we be expecting in USD INR with this kind of moves happening?
Hey, good morning. I think while we were away, a lot of things have happened in the global markets, and most of the market segments were under pressure. And there were several reasons. Few economic numbers from US, and then the statements from Fed members. Like Conference Board's Consumer Confidence Index came at 103.2, and it was expected 95.7. Sorry, 97.7, and it has beaten the highest projection also in the Reuters survey. And again, job openings like George showed that solid jobs July report was not a fluke, and it printed 11.239 million versus 10.35 million for forecast, and June's report was revised to 11.04 from 10.69. So this is quite a solid jobs market that we are seeing in the US. And only weak number was, of course, the ADP jobs report that came at 1,32,000 versus 2,68,000 in July. And this has to be seen in the background of non-farm payrolls, which is expected in the range of 3,18,000. But broadly, economic numbers have been very strong. Then there was a shocking inflation report from Europe, where it surged to 9.1% in August versus a forecast of 8.9%. And versus the core inflation zipped to 4.3%, up from 4% in July. Then there were interviews with the Fed Williams. He said we are going to need to have restrictive policy for some time, and he, killed any expectations of a rate cut next year, citing that possibilities of inflation remaining sticky is very high. Another member, Mr. said the rate should move up to 4%. So all these things have really had a big impact on the markets. US yields have soared amid the stronger data, and the hawkish statements. Two-year yields have broken 3.5%, which was last seen in 2007, recording 70 basis points in August, increase in August alone. 10-year has broken 3.2, a rise of 70 points again in 1 month. 30-year is slightly lagging them both with a 50 basis points rise. German yields have risen a whopping 85 BPs from 67 to 1.52. Italian sovereign yields, where there is a lot of focus because of the peripheral economies challenges, was at 3.88%. That was last in 2014. So let's recall that in 2014 is when ECB started pursuing easy money policy, looking at the problems that the Eurozone had. Global index of stocks have lost nearly 2% in the last 2 days, losing almost 8% from the recovery peak hit earlier in the month. Nasdaq, that remains sensitive to rates, has lost nearly 11%. Coming to dollars, again, a lot of currencies have made a new cycle low, like GBP below 1.16, JPY very close to 140, and CHF, which is very rarely followed of late because of the high level of volatility and also high level of intervention from the Swiss National Bank. That has lost quite a bit in the recent session, about 3%. The trigger seems to be a fall in the, KOF economic indicator that has fallen from 90.5 to 86.5. Also, there seems to be good support because Euro CHF, which seems to be a target of selling that has stopped, and euro seems to be getting a very good support because of indirectly because of USD CHF rather. Euro itself had another bounce from below parity. One is the German yields going up. In fact, German two-year yields are also going up much more than the US two-year yields. That's a support because the short-term market always favors whichever currency is giving a higher rate in the short term. And also the natural gas prices, which fell for the second day in succession. The natural gas prices falling may have a lot to do with the announcement that Germany has stocked up uh, the gas requirement for most of the winter, and I think also some murmurs that the Iran oil deal can be signed. So Iran nuclear deal can be signed. So oil prices have again slipped, and maybe may have had some impact on the natural gas prices also. All in all, I think euro has had a good support, but as far as the other markets are concerned, other currencies are concerned, they have been still under pressure. GBP, for instance, is staring at some of the analysts pointing to 20% inflation in the coming month. So yen, obviously, the higher yields in the US once again started the ball rolling for more carry trades by the players, of course. So all in all, a very strong dollar. We look forward to important data tomorrow. That's on the jobs. I think it only a stronger number will only strengthen the Fed's statement recently that they need to go a long way in hiking the rates. Coming to our own rupee, yes, it was a surprise move downside. Most did not expect a move of about 50 paisa in one single session on the lower side, while most of the people would have been expecting a higher dollar rupee and a break higher because dollar index had risen and the risk sentiment was poor. But not only did the dollar rupee fall, but also the stock market had a whopping 2.5% rise in major indices. Probably that's the reason why the downside move got exaggerated, because people started with the feeling that rupee will weaken based on the dollar index moves. And of course, month-end flows, reportedly from MSCI rebalancing a large flow, which did not get absorbed by the usual buyers. That probably exaggerated the move. From here, do we have continuation of similar flows in the coming days? That's one factor that will determine. Secondly, the global factors, dollar index, how far it goes from here. It's still holding that 109.30 level. So if it breaks that convincingly, again, that will be another reason. Oil, of course, is slightly supportive for the rupee. Foreign investors, of course, have pumped in 56,000 crores in August. That is the highest monthly number since December 2020. That's a very good number. Definitely, a section of the foreign investors or global investors are looking at a higher growth rate for India and inflation getting slightly moderating due to the efforts of RBI, and also possibilities that Indian sovereign bond might get listed in the global bond index. So these are the factors that working positively for the rupee, but definitely global factors like continued deficits on our trade, and also the dollar index moves maybe countering the continued strength in the rupee. I expect that the rupee at least in the near term will hold 79.30, and before the non-farm payrolls we might be revisiting 79.80 as well. Yeah, thank you.
Okay, JK, and quite an interesting kind of move that we have seen for USD INR, and so much as to say there were certain positives for the currency with equity markets booming and flows coming in. We've seen the highest flows since December 2020 in a month. That's quite significant, but at the same time, folks, we had the Indian GDP numbers released. And the numbers were lower than the estimates by our central bank. The Q1 numbers of GDP for FY23 stood at 13.5%, which is lower against the 15.6% of RBI, though there may be some sort of a base effect on this, but the uh, updates seem to be on the lower side of the expectations. On the other side, we had also seen some bit of correction in the oil prices, which is good for the Indian market. Uh, all said and done, on the global side, the jobs market continues to stay strong for the US economy, a silver lining in the recession expectations and the persistent inflation that we're seeing. Lastly, we've seen the 2-year yields breaking above the levels last seen in 2007. Now, that's quite an interesting move on the yields, and it's not just the 2-year yields, but across the globe, we have seen the yields rising. So, there's a lot of things happening around in the financial markets, and we hope to keep you updated with all the updates that we cross by. That's it for today. Thank you, folks, for listening. We'll come back again tomorrow morning.